You have your brokerage account. You know what ETFs are. You understand that a diversified portfolio can contain US stocks, international stocks, and bonds. But now comes one of the most important questions. How much should you put into each? Should you invest 90% in stocks and 10% in bonds? Maybe 70% stocks and 30% bonds? Or perhaps 50% stocks and 50% bonds? Which one is correct? The answer is, there isn't one correct allocation for everyone. Your investment horizon, your ability to tolerate losses, and your financial situation all matter. And by the end of this video, you'll have a framework for deciding what allocation makes sense for you. Let's start with something important. The difference between two broad US stock ETFs may be relatively small compared with the much bigger decision of whether your portfolio contains 90% stocks or 50% stocks. That's because asset allocation determines how much of your portfolio is exposed to different types of investments, and therefore how your portfolio is likely to behave. Stocks provide greater long-term growth potential, but they can experience substantial declines. Bonds generally have lower expected returns than stocks, but they can help reduce the volatility of the overall portfolio. So deciding how much to allocate to stocks and bonds isn't about finding the perfect number. It's about finding a balance between growth and risk that you can actually live with. The first question is, when will you need this money? Imagine two investors. The first is 30 years old and is investing money they don't expect to use for another 30 years. The second is 62 and expects to start using this money in 3 years. If the stock market falls dramatically tomorrow, these two investors face very different situations. The younger investor has more time to recover from a temporary decline. The person approaching retirement has much less time. But there's an important nuance here. A longer investment horizon does not make stocks risk-free. It simply changes the nature of the risk you're taking and gives you more time to deal with temporary declines. That's an important distinction. The second question is, how much market decline can you tolerate without abandoning your plan? Let's imagine that you have $100,000 invested. A 40% decline would temporarily reduce that portfolio to about $60,000. Could you continue following your investment plan, or would you feel compelled to sell? This is important because a portfolio that looks perfectly reasonable on paper can become a very bad portfolio for you if you panic and sell during a downturn. Risk tolerance isn't about saying, I don't mind risk. It's about understanding how you are likely to behave when your account balance is falling. And you don't really know the answer until you've experienced a major decline. That's why we should build portfolios that allow us to stay invested even when markets become uncomfortable. There's another distinction that is just as important. Risk tolerance is how much risk you are psychologically comfortable taking. Risk capacity is how much risk your financial situation can actually afford. These aren't necessarily the same. Imagine someone with a stable income, a well-funded emergency fund, no significant debt, and decades before retirement. They may have a relatively high capacity to withstand a temporary market decline. Now imagine someone who needs most of their investment portfolio to pay for a house in 2 years. Even if that person says they're comfortable with risk, they don't have the same capacity to absorb a large loss. So don't ask only, how much risk can I tolerate? Also ask, how much risk can my financial situation afford? Evidence Corner. Does time make stocks safer? There is an interesting debate in financial research about how investment risk changes with the length of time an investor holds an asset. Campbell and Vasiris studied this question using historical US data and a model of long-term portfolio choice. Their research found that the behavior of risk can be different at different investment horizons. For example, in their long-term annual dataset, they found evidence that stock returns were mean reverting. The annualized volatility of stock returns declined from about 18% at a 1-year horizon to about 14% at a 25-year horizon. At the same time, short-term treasury bills behave differently. The uncertainty associated with reinvesting them over long periods could actually increase their long-term risk. That might sound like evidence that stocks become safe if you hold them long enough. But that's not the conclusion we should take from the paper. The authors explicitly challenge the simplistic idea that long-term investors can simply treat stocks as safe assets. Their results depend on assumptions about return predictability, interest rates, inflation, risk aversion, and the investor's ability to adjust the portfolio over time. The lesson for us is much simpler. Time horizon matters, but it does not eliminate investment risk. A long-term investor may be able to tolerate more exposure to volatile assets because they have more time to deal with fluctuations, but that is very different from saying that stocks are guaranteed to recover. And this is one reason we shouldn't choose an asset allocation based solely on historical returns. Let's make this concrete. Suppose we compare three hypothetical portfolios. Portfolio A, aggressive, 90% stocks, 10% bonds. This portfolio has a large allocation to assets with greater long-term growth potential, but it can also experience substantial declines. Portfolio B, moderate, 70% stocks, 30% bonds. Here, bonds have a larger role in moderating the fluctuations of the stock portfolio. Portfolio C, conservative, 50% stocks, 50% bonds. This portfolio gives bonds a much larger role and therefore generally sacrifices some growth potential in exchange for greater stability. These percentages are examples, not recommendations, and this is where we can use Portfolio Visualizer. Instead of simply saying that one portfolio is aggressive and another is conservative, we can test actual ETFs. For example, we could construct the portfolios using VTI for US stocks, VXUS for international stocks, and BND for bonds. Then we can compare how these portfolios behaved historically. When comparing these portfolios, don't look only at the final return. Look at several measurements. Annualized return. How quickly did the portfolio grow over the period? Volatility. How much did its returns fluctuate? Maximum drawdown. How large was the biggest decline from a previous high? And perhaps most importantly, how would you have felt living through that decline? A portfolio that looks excellent because it produced the highest historical return may not be the right portfolio if its drawdowns would have caused you to abandon it. The goal isn't to maximize a spreadsheet. The goal is to build a portfolio you can actually stick with. Where do international stocks fit? There's another important detail. Suppose you decide 80% stocks, 20% bonds. That doesn't tell us how the 80% stock allocation should be divided. You could have 60% US stocks, 20% international stocks, 20% bonds, or you could choose another allocation. The important thing is to recognize that asset allocation happens at more than one level. First, you decide how much risk you want from stocks versus bonds. Then, within your stock allocation, you decide how much exposure you want to the US and international markets. And, as we discussed in previous videos, international exposure can include developed and emerging markets. At this point, you might be hoping that I'm going to tell you the perfect percentage. I won't, because there isn't one. A 90-10 portfolio might be appropriate for one person and completely inappropriate for another. A 60-40 portfolio might be comfortable for someone else. And your appropriate allocation can change throughout your life. Your income can change. Your financial responsibilities can change. Your time horizon gets shorter. And your ability or willingness to tolerate losses can change. That's why asset allocation isn't something you decide once and forget forever. It's part of your financial plan. Conclusion and your assignment. So let's bring everything together. Before choosing your target allocation, ask yourself 3 questions. 1. When will I need this money? 2. How much of a temporary loss could I tolerate without abandoning my investment plan? 3. How much risk can my financial situation actually afford? Then create a simple target allocation. For example, 80% stocks, 20% bonds. And then decide how you want to divide your stock allocation between US and international markets. Again, these percentages are just an example. Your task is to establish your own target allocation based on your circumstances. If you're just starting with a brokerage account, this is your opportunity to create the target allocation you would like your portfolio to have. If you already have a retirement or investment account, compare your current allocation with the target you have established. Then, in the next video, we'll learn what happens after you've chosen those percentages, how portfolios naturally drift over time, why that happens, and how to rebalance them while keeping unnecessary costs and taxes to a minimum. Remember, understand the foundation, build a simple structure, and let time do the heavy lifting. Thank you for watching, and I'll see you in the next video.